So next, define product and period costs and explain how they impact the financial statement. So you're gonna have to memorize all these slides, right? Memorize these terms. There's a lot less slides than pages in the book, right? All the words on all of these slides that I'm giving you probably make one page of one of your books. So just memorize this stuff, make your life easier. Direct labor. Pieces that go into a product. So we talked about direct labor, we talked about direct material. Manufacturing overheads, just anything not in these two buckets. So your factory overhead costs include your electricity, maybe your rent, maybe your supervisor costs, but they have to go into making the product. They have to go into making the product. Period costs don't go into making the product, and that's what we we're just talking about, Emmy. So you did a great segue here, where if the period costs, if they're like selling costs or they're administrative costs, there's something called period costs. So they're not related to the product. We could call these a type of indirect cost as well, but a better term for them is period costs. They are expensed and not attached to the product. These three items are always attached to the product. So examples of manufacturing overhead, again, this is the most confusing piece, are going to be your supervisor cost, your electricity, your water, your rent. But anything you need, like your rent for your factory, could be a product cost if it's related to developing your goods. But your rent for your corporate office that isn't building goods, that's more of a period cost, and which is also known as SG&A, selling, general, and administrative, because they're incurred to obtain orders and deliver finished goods to customers. Potentially, they're occurred. Your main office was more likely administrative, so it has nothing to do with non-manufacturing costs. It houses your selling staff, or it houses your accountants and your finance team for admin functions. So right now we've got 6 terms. What are those 6 terms we've talked about? Quick quiz for everybody. I want you to be thinking about this. What are the 6? Go ahead. Fixed. Yep.
Variable.
Variable.
Direct costs, indirect costs.
Yep.
The product and period.
Product and period. Yeah. Fixed, variable, product and period, and then we had our direct and indirect. Right. So memorize that stuff. That's all I'm saying. Memorize, know the differences of it. If I ask you what a product cost is, the first thing that should come into your head, well, oh, it's direct labor, direct material, and manufacturing overhead. Put it on a flashcard. Make sure you learn. It's those 3 components. If you know what, if I ask you what direct labor is, oh, it's just labor that's going into building a product. And have some examples on your flashcard. I said, what's a period cost? Well, those are other items like selling, general, administrative costs that really, they don't really build a product. And they kind of, all that kind of makes sense, right? Give me an example of a direct cost. Oh, direct cost could be direct labor. Give me an example of indirect cost. Oh, that might be, you know, your rent. Give me an example of a fixed cost, your factory. Give me an example of a variable cost. Oh, the cost of the direct material, the cost to build each product. And so really not, hopefully not too intense if you just understand the examples. So 13 slides, but really only 6 definitions we have to worry about so far. Period and product cost and financial statements. Period costs go onto the income statement through expensing. And this goes back into your financial accounting. While your product costs go into inventory and cost of goods sold. And so the idea here is your period costs are going to be expensed as selling, general, and administrative on the financial statements in the income statement, while any product costs have to go into inventory. And then any inventory sold goes into cost of goods sold, which goes to the income statement. So we have an asset on our balance sheet related to the costs. What's another word for a cost that we've brought onto the balance sheet? Bringing back financial accounting a little bit. The idea here, and this is all terminology, right? That's why I'm testing you all. This is a capitalized cost. Product costs are capitalized costs. And why is that? Because of the matching principle, right? We try to match, in GAAP, we try to match expenses to the revenue they create. We recognize revenue when the products are sold. And so we have to capitalize those costs and recognize that expense when the revenue is made, when we sell the good. And so that's why we might have inventory on that's why we have inventory on our books, which is a capitalized cost. Does that make sense? All right. So here's some identifications. Memorize this slide. Right. I'm sure this will be on your quiz or test. One or the other. Bicycle tires and wheels. Is it fixed or variable? Well, it's variable. Why is it variable? Because we can buy more to build more bicycles. Is it direct or indirect? It's direct, right? Because we're using it directly to build a bicycle. Is it product cost or period? It's a product. Wages for assembly worker. It's variable, right? As they create more, if they're hourly, then we're going to pay them more. We might argue it's a fixed cost if they get salary, but generally we're going to see assembly workers are hourly. Is it direct? It's directly building those goods, right? So it's a product cost. Advertising, it's fixed. Generally, we're paying a fixed fee or we're paying a salary to our advertising. It's indirect, and it's a period cost, right? Advertising doesn't go directly to creating a product. And we're thinking about manufacturing products here because some people might say, well, if we're an advertising firm, then we're creating an advertising product. Let's not make those cognitive leaps in this class. Let's just try to stay with the assumption that we're making bicycles or we're making products. Production manager salaries, fixed, right? Salaries fixed, pay a fixed rate. It's indirect, and we're saying here production manager because he's in charge of the production line. We're calling it a product cost. Because if it said he was supervising someone, or if he was supervising multiple different production lines, it would be more potentially a period cost. But he's saying he's in charge of that specific production, so we can assume those goods couldn't be created unless he was there. So that's the thought. If we have an accountant isn't there, those goods are still going to get created. But if he's in charge of that specific line, well, we can assume it's the product cost. Honestly, I'm not a huge fan of this kind of question, and I'll try to make sure that these kind of ambiguous ones aren't in, and if they are, I'll adjust. But for the homework, I can't change the homework. It's pre-designed, so just try to work with it. Depreciation, it's going to be fixed based on the equipment we bought. It's indirect. We can't trace it to the products. It's a period cost. Factory depreciation, fixed, indirect, but we might be able to trace it to a product. If we're creating multiple products, or if it also has SG&A in it, it might be more difficult to do it. We might call it a period cost. It's really, remember, this is up to the discretion of the managerial accountant to determine if the factory is only making products, then we might be able to allocate it on a product cost. But if it houses anyone else, we might not be able to. Oil and grease applied to grease chains. This is variable, but we know it's product and it's an indirect cost. Sales commissions, that's going to be a period cost, indirect and variable. And so I know these can kind of get, there's a lot of judgment used in these. And so I'd recommend memorizing this list for the homework and quizzes. If it's anything that's saying specific, so I'd assume for this book, assume like factory depreciation, they're going to assume you're only making one item in that factory and you don't have anything else going on, like no supervisors or anything related to the administrative. But in reality, in a factory, we might also have our headquarters buy it, and it might be difficult, and some companies might call that period over product. But just memorize this for your book, for your course and your homework. So for service companies, these cost concepts are generally applicable to service companies. For example, the cost of beverages for passengers of Southwest is a variable cost based on the number of passengers. The idea here, you can also use these concepts for services to determine the cost per passenger. And so as a consultant, I could allocate how much the cost of my software and the cost of my computer by customer and determine how profitable my business is. So we can use these for service companies as well. That's what this slide is trying to get at. But ultimately, we're going to be focusing on manufacturing companies in this class. Typical manufacturing costs, we're generally looking at most of it being materials and overhead, with a very little bit being labor. And the idea there, unless it's a very complicated good, generally we're looking at not very skilled labor for a lot of the manufacturing jobs, right? So most of the cost is going to come from materials and overhead. Direct materials, direct labor and overhead, we talked about. These are expenditures for directly related to building and making a finished good. Example, steel for a mountain bike. Direct labor, wages paid for a mountain bike. Again, I think this is a bit redundant, but might as well beat the nail with a hammer. Direct labor costs are the wages and salaries of direct labor that are separately and readily traced to the manufacturing process. In other words, we know that that's required to build the good. And overhead is manufacturing costs that we can't directly trace to the finished goods. So they're saying maintenance, cleaning supplies, factory utility costs, supervisory costs. And then finally, we have these way we can bucket it. Another way we can bucket it, again, this is just terminology, are prime costs and conversion costs. So direct material and direct labor together are known as prime costs. Direct labor and manufacturing overhead are known as conversion costs. The easy way to remember this is if it's direct, it's prime. That's that way I think of it. If it's direct, it's prime. And then how do we convert products? Well, how do we convert materials? We convert them using labor and overhead. Right? If I have a raw good, if I have a piece of metal, how am I going to convert it? I have to have someone work on it, and I have to have electricity and all this other stuff. That's the labor and overhead. But direct is prime. So direct labor and materials are considered prime costs. This is just definitions. And conversion costs are going to be your labor and overhead. We also have non-manufacturing costs. We call those as period costs. We call them admin. To think about it as like your accountants, or just think of it as your SG&A, selling, general, and administrative costs.